Hello, this is the chart profit video, Friday 9th of December. We're about 2 hours into the trading day. Just going to start with a bit of a review. We're looking here at comments from pre-open on November the 10th, this day here. At that point the market had been in quite a range for quite a while. We'd seen highly volatile market reaction to the election at this point here, and then I think the following day, November the 10th, pre-open, I said most importantly the 6-month point of control has migrated to 2159.50. That's this level here, and that happened on that day or overnight. Went on to say this is a logical price for the point of control to emerge as the distribution completes. This suggests that a new distribution, a directional move, may be about to begin, and so price relative to this level would be extremely important to follow. The Emini has shown strong resilience and bounced a long way back, but I said that price back below this level would not confirm strength. Best outcome and a big positive would be significant buying green printed above that level. That would obviously at that point have indicated that the next directional move was going to be higher rather than lower. Just looking at that on the auction chart, here's the 10th, and then just a couple of days later we had this green significant aggressive buying at that point. It marked it again here. We had a little correction, a couple of days there was some significant selling, but it didn't amount to much. By this time the breadth was improving, the momentum on the pulse chart was also up, and now of course with auctions swiftly higher through here, getting on for 100 points higher at the moment. Obviously we're getting overbought. We've got an RSI up here, which is above 75. I don't think we've seen that for an awful long time. I think it's probably years, but we are extremely overbought on the technical oscillators. Okay, I've switched to the spider chart. We can see the 14-day RSI here, which is up around 75, and the last time we were this high, or almost this high, was back over here in 2012. As I said last week, with the major indices breaking out to new highs, it's difficult to find any local controlling prices to key from. For instance, on this chart, the 11-month is down here. That's the best support on this chart, but nothing close. We can use other charts. This is the XLK, the tech sector ETF, with its support here at 47. That's quite a bit closer. And price down here would be indicating a major change of trend, but currently we're quite comfortable seeing the rally this week. Similarly on the Qs chart, price back below 117.25, the 1 year, would be an indication of weakness. So they will give us a clue, read general market weakness, rather than something like the Russell, which has broken out here to new highs with no key levels. Of course we have this level here that we follow each day, 2200, which is the minor 5-week point of control on the E-mini. First sign of weakness, as I've been saying, would be price printing time below that level. So this week, of course, all the value areas have been printed above that support. In fact, we found very clear support on Monday and Tuesday before the market took off. UK FTSE 100 index have been finding resistance here at the 6-month. We're now finishing the week above that level. And I just want to look at this from the pre-open today. This is regarding the RightX assets ratio, so we're going to look at the sentiment here. On Thursday, my version of the RightX assets ratio, that came lower, fell quite swiftly to 5.18. Now, considering that the ratio was 8.48, an 11-month high just 3 days ago, it's now fallen to a 97-day low as the market has come higher. And as I said on Tuesday, ratio at an 11-month high, which it reached on Monday, is always worth noting as a warning, but it seems that bear fund assets and bull fund assets both fell sharply yesterday on Monday, and that's rare. Bull fund assets falling 19% in 1 day would usually be a positive. As I said today as well, we've got some unusual sentiment here. That kind of fall in the ratio nearly always happens after the market itself has been falling sharply, and that usually tends to mark a capitulation point. So when we see the ratio fall about 30% in 3 days, it's usually after a decline, maybe a long decline in the market, and usually marks some kind of capitulation. Whereas this week we've seen the opposite. We've seen the market rallying as that's been happening. I can't kind of interpret that in a kind of negative way. ratio falling as the market moves higher is usually bullish. So just to show you what how that happened, what it looks like on the chart, here's the assets ratio in the bottom here. Here's the 11-month high that we reached earlier in the week, and you can see the decline here, the 30% fall, I think at least. Actually, it's a lot more than that, I think, in 3 days as the markets come higher. So this week you can see the bear fund assets here have rallied, indicating an increase in fear. And the bull fund assets, having reached an 11-month high itself, have fallen quite sharply, again indicating fear and all of that as the market's been rallying. So it looks like the retail traders, the RightX guys, are not buying this rally, literally or mentally. So here we can see, just over 3 days, the change in the RightX at the bottom here. It's just got this change indicator based on the RightX. So we're down a lot more than 30% in that ratio in 3 days, and I've just marked on the screen here on the chart where that normally happens. So you can see it's normally at market lows, or at least corrective lows here, and marks some kind of capitulation in the market. There's a couple here which came on the rally, but this was off an extremely oversold market decline, panicky decline down here. So we had some selling into the rally, which then extended, but unusual. We look at the longer term sentiment indicators, the public poll from AAII, the bulls percent slightly lower, 43.1. Did reach 49.9%, the bulls percentage, a couple of weeks ago, and that was the highest bulls percentage since January 2015. So market was rallying at that point. The sentiment, at least this public poll, was getting a little overheated a couple of weeks ago. The net, the bulls minus the bears, was down at the moment, 16.6, down from 27.8 2 weeks ago, and that was the highest since February 2015. So getting a little bit overheated 2 weeks ago, but since then the bulls percentage has come lower, the bears percentage has gone higher. Now this one, the Investors Intelligence poll, newsletter writers, in this one the bulls percentage this week was higher at 58.8, and that is the highest since February 2015. And the bears percent was lower at 19.6 this week. That's the lowest since August 2015. And the net, you can see it here, this single histogram line here, that's actually the highest at 39.2 this week. That's the highest since May 2015. Back over here, if we look at the active money managers index, we call it the exposure index. It was higher this week at 101.6. Now that indicates a leveraged position, average leveraged position, because this exposure index measures the current equity exposure of active money managers, and it says here 100% would be fully invested, so they're more than fully invested, and that is just, we've only got one higher reading than that, which was back over here. And I must say, and I've said it many times, that this indicator is really good on the lows when we see very low numbers for this exposure index, and that normally corresponds or close to market lows. But high readings, to be honest, I can't think we can view the high readings for this indicator in a kind of contrarian fashion. Just don't seem to work. And we're seeing Lipper US fund flows this week report equity fund, including ETF outflows of -2 billion in the week to the 7th of December. We have a reasonably high 4-week flow number. It reached 23.36 last week. Previous week that was the highest since March 2015, so it's a little overdone, up at levels that have previously corresponded to market tops or levels where we've seen the market decline subsequently. But like the RightX indication, we've seen an outflow this week. Unfortunately, we've seen the bond market back towards those lows again today. There is major support at 117.15 here on the TLT, the T-bond ETF chart. And with the rally in the dollar continuing, we're seeing GLD, the gold shares ETF, again back towards the recent lows today. The oil fund ETF, USO, as we know, found support here at this point on the halfway from this low to this high. Found its way back above, a little bit of resistance here, the major at 1078, and is still currently printing above that level in a strong price location. And there we can see the dollar index rallying strongly back towards those highs that we saw a couple of weeks ago. And as you'd expect, we're seeing the euro, FX chart, the euro here, heading back towards its recent lows. Okay, that concludes. Once again, I wish you a good weekend and thank you for watching.